Canada's largest uranium producer stopped its flagship mill this morning, not because of a reactor shutdown or a market crash, but because a single bridge collapsed in northern Saskatchewan. Cameco announced the temporary halt of its Key Lake mill and reduced operations at McArthur River, the world's largest high-grade uranium mine, after the Smoothstone River bridge failure cut off the primary supply route. The company confirmed its sites were not directly flooded; the infrastructure around them was. That distinction matters because it means the production loss is entirely conditional on road restoration, not on ore quality or market conditions. The direct production impact that analysts at Uranium Equities are tracking is approximately 1.5 million pounds of uranium. To put that number in context, McArthur River alone accounts for roughly 13% of global uranium production. The mine's slurry tanks and mobile truck containers carry only a limited buffer before a full operational halt becomes unavoidable. Meanwhile, markets elsewhere in the session moved on a different kind of tension. Copper neared a record high on China demand and supply fears. Oil climbed again as U.S.-Iran tensions resurfaced, and Qatar asked vessels at its key LNG port to go dark for safety. The S&P TSX composite held roughly flat, caught between oil windfalls and trade war anxiety. The Bank of Canada's market participant survey flagged geopolitical and trade risks as the dominant threat, with 82% of respondents naming Middle East tensions as the primary concern. Against that backdrop, Cameco's halt registered as a logistics footnote in most market commentary. The question the session did not answer is whether that framing is correct.
The mechanism behind today's halt is unusual enough to warrant unpacking, because it exposes a vulnerability the uranium bull thesis has not yet stress-tested. Uranium is not shipped like oil. There is no pipeline from McArthur River. The processed yellowcake moves by truck over a road network that, in northern Saskatchewan, runs through terrain that floods seasonally. Cameco noted that an alternative route exists, but that restrictions on that road limited the company's ability to reroute critical operating materials. Translation: there is no meaningful redundancy. A single infrastructure failure is sufficient to pause production at the world's highest-grade uranium deposit. The uranium supercycle narrative, which has driven Cameco stock, CCO on the TSX and CCJ on NYSE, to multi-year highs, rests on the premise that supply is structurally constrained and demand from nuclear restarts is secular. Both of those premises remain intact. What today surfaced is a third variable the bull case underweights. The physical logistics chain connecting Canadian ore to global conversion and enrichment facilities is remarkably thin. Saskatchewan's Ring of Fire analogy is not gold or copper. It is a mine-to-mill-to-port chain that runs through 2 roads and 1 bridge. The reversal condition is embedded in the timeline. Cameco stated it will not resume full operations until normal deliveries can restart, and the restoration timeline is unknown. If the Key Lake mill is down for a full month, McArthur River almost certainly enters a total production halt, not because the ore is gone, but because there is nowhere to put it. That outcome would push the 1.5 million pound impact significantly higher, toward a number that begins to matter for spot uranium pricing, which has already pulled back from its 2024 peak above $100 per pound, toward the mid-60s range where utility buyers have been slow to re-engage.
The unresolved question from the halt is not whether Cameco recovers, it will, but whether this spot uranium market responds to the production gap, and whether the response is proportional to the supply removal or muted by existing utility inventories. That question has a historical counterpart. In 2006, flooding at Cameco's Cigar Lake project, also in Saskatchewan, triggered an 18-month suspension of what was then the world's largest undeveloped uranium deposit. Spot uranium prices more than doubled in the following 12 months. The mechanism was not immediate panic. It was the slow accumulation of utility buyer anxiety as replacement supply failed to materialize. The current situation differs in scale. Key Lake is operational, not under development, and the flood damage is to transport infrastructure rather than the mine itself. But the signal the 2006 episode left is that uranium markets price supply disruptions with a lag, not in real time. The continuation scenario runs through road restoration speed. If Saskatchewan repair crews restore the Smoothstone River Bridge or clear the alternative route within 2 weeks, Cameco absorbs a short-term production shortfall, inventories buffer the gap, and spot prices remain range-bound. The breakdown scenario, the one that would force the supercycle thesis into an uncomfortable position, requires the halt to extend past 30 days. At that point, McArthur River's full output stops. The 1.5 million pound estimate becomes a floor rather than a ceiling, and utility buyers who deferred long-term contracting in the mid-$60 spot environment face a different calculation. The leaning here is that restoration comes faster than a month, that the immediate production impact stays near the lower estimate, and that spot uranium absorbs the news without a significant move. But the thesis the session did not resolve is whether Canadian uranium infrastructure, specifically the road and bridge network linking the world's best deposits to the global fuel cycle, has been priced as the supply chain risk it actually is. Barrick's $3 billion share buyback, announced today ahead of its planned North American spinoff, is receiving far more capital attention. The verification benchmark is simple. Watch CCO's price action over the next 5 trading sessions relative to the spot uranium move. If the stock decouples from spot, falling while spot holds, the market is assigning a company-specific infrastructure discount it has not previously applied. If both hold, the supercycle thesis absorbed today's data without revision. What would prove the cautious leaning wrong is spot uranium breaking above $75 per pound before the road is restored. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.